Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here with my friend and colleague Adam Turnquist, back from the Thanksgiving holiday. It is December 1st, 2025. As we're recording this, hopefully everybody had a nice Thanksgiving. Certainly, we did here. How about you, Adam? How was the Thanksgiving? With the young kids in your house, it might not have been as calm.
It was not calm. We hosted Thanksgiving here. I think we had over 40 people come over. So it was a
Wow.
busy, hectic few days just getting ready and then, of course, cleaning up. But we had a lot of fun. It was good. We got some snow over the weekend. So it actually feels like winter now, although that requires more snow blowing, more shoveling. So I was glad to get back to work. It feels like a little bit of a break from all of the physical activity and cleaning over the weekend.
So your vacation can start now.
Yeah.
So enjoy it. Yeah, we just hosted my in-laws. It was a pretty small gathering and very relaxing. In fact, we didn't even cook a turkey. We just got catered in, and it was about as relaxing of a Thanksgiving as we have had. So thankful for that, and thankful for all of you for being regular Market Signals listeners. So while you're looking at the disclosures here, I'll give you the quick agenda. So we just put out our weekly market commentary for this week. It's on LPL.com. So 2 weeks ago, we wrote kind of a sneak preview for the Outlook for 2026, which comes out a week from Tuesday, as you're listening to this, a week from today, I'll say. And so 2 weeks ago, we did a preview. We continued the preview this time with sort of under the radar keys to next year. Not really giving away the outlook itself, but just telling you what topics that we hit. So we started 2 weeks ago with economy, stocks, bonds, high level. And this outlook, sneak peek part two, uh, goes into some other areas, let's say geopolitics, commodities, the election, midterm elections, alts, things like that. So here you see agenda. We'll do a quick recap of last week and last month. Both, well, last month wasn't particularly strong, but certainly it was positive and finished strong because we had a nice gain last week. And then chart check, Adam, you titled your section "Call It a Comeback." I just alluded to that. We had to rally furiously to get to a positive November for the S&P 500. Here's your under the radar keys to 2026. And then for week ahead, there is some data this week that matters that we're going to get that's timely, but there's not a lot of it because a lot of it's been delayed and a lot of it's still stale. So my week ahead preview, I titled just Shop Till You Drop because it is holiday shopping season. All right. So market recap. This look, this is a 5-day look, right? So the S&P was only up 3.7 only last week, Adam, but 4.8 over the last 5 days. That is a really strong 5-day period. What do you think were the key drivers?
I think part of the story for last week, we came in oversold. We had some Fed commentary leaning more dovish for December. So there was a big repricing of rate cut expectations for December, not to mention Kevin Hassett being the likely nod for the Fed chair. We'll get maybe an announcement this month on that. That's exactly what the market wanted to hear, that rate cuts are still on the table for December and maybe a little bit more of a dovish outlook from the Fed. So I think that was part of the story. There was some indigestion, we'll call it, from the AI enthusiasm that seemed to re-engage a little bit, even though there's a lot of dispersion within those mega cap companies. That was really, I think, the big driver, risk appetite coming back last week in a big way. S&P up 5 straight days, as you mentioned, a 7-month winning streak now coming into December. Buying pressure also pretty broad. It wasn't just a handful of names doing the heavy lifting as we've seen for the last couple months. I think nearly 90% of S&P 500 stocks finished higher. Breadth on the month also slightly positive. So a good sign, at least for now, going into December.
Yeah, absolutely. I know you have a seasonal chart a little bit later, but typically this period is strong when you go into it strong. and obviously this has been a great year. Total return for the S&P 500 through Friday, 17.8%. We're down a little bit here as we're recording this Monday afternoon, but not much. So call it 17 and a half. We'll take it. I think at least looking at last week, Alphabet shares have been very, very strong. They're up almost 70% year to date. But last week, that was a big reason why the communication services sector did so well. Tech did not do as well. It did fine. It's kind of like a marginal underperformer. But some of that AI scrutiny and concerns about NVIDIA maybe losing some share to Google and AI chips cause you alluded to it, Adam, a little bit of dispersion in the Mag 7. So that weighed on tech just a touch, but certainly hard to complain about. 4.4% over the last 5 days. In terms of looking at the month, healthcare was a really strong outperformer. And then that sort of AI scrutiny showed up in terms of tech and CD, consumer discretionary, lagging. A lot of tech and CD. Those two sectors were the worst performers for the month. Certainly the consumer lagging is reflective of an increasingly challenging consumer spending environment. And not falling off a cliff, but clearly we're seeing signs of a slowing job market and increasing pressures on consumer spending. So that certainly will be something to watch as we get into 2026. I guess, Adam, in terms of international markets, Europe's done pretty well lately. Here you see 2.9, not as good as the S&P, but 2.9% over the last 5 days. Japan may be falling a little bit behind. We just talked about this before we jumped on this call that BOJ is looking like it's going to hike this month, right? And
Right.
that's pushing yields up. There's been some jitters in that market here recently, and certainly there's more today.
Right. And you have this kind of bifurcated dialogue in Japan. You have their new prime minister who's pro-growth, keeping interest rates very low. But for the Bank of Japan, when you look at inflation measures right now, it's been above their target for quite a while. That's putting pressure on the BOJ to normalize interest rates from a very low level. We had a big repricing overnight from some hawkish commentary from their Bank of Japan Governor Ueda. That created a move higher in 10-year JGBs or Japanese government bond yields. That's pushing treasury yields higher today as well. So that's, I think, just a little bit of a repricing of those hawkish rate hike expectations for I guess this month now. Got to adjust to the calendar, weighing a little bit on risk appetite in Japan. And the market there overbought. It's had a significant rally. You can see year to date, the Nikkei up 28%. So probably due for a little bit of a breather here.
Yeah, certainly the tough talk on Taiwan didn't help matters in that market either from the new prime minister. So turning to bonds, great week for bond market. Every bond category was up over the last 5 days. So Adam, certainly increasingly likely we're going to get a cut from the Fed December 10th. That is certainly a big reason why bonds were so strong. Do you see anything else? When stocks are up, credit does well, typically. Anything else you're seeing in the bond market?
So technically, if you look at treasury yields right now, the 2-year, which is a good proxy for the Fed funds rate, registered a marginal higher low. So we're looking at a key support level. 2-year came into that support level, didn't quite get there. I think that's really interesting context considering where the market's repricing rate cut expectations. I think I looked earlier today, almost 100% odds of a rate cut next month or a rate cut in December. This month. I'll get there by the end of this new December here. But yet the 2-year hasn't really dropped to a materially low level, and it's still holding above that support level. I think maybe that suggests technically that we might not hear as dovish a dovish outcome as maybe the market's expecting next month. Even when you look at December next year, I think there's about a 75% chance for 4 cuts between now and next December. So one next week and then an additional three. That's what the market's expecting. When you look at some of the economic data, though, we'll get through that this week. Some employment data. It'll be interesting if they can really make the case for future cuts and to really meet expectations from the market that have again been drastically repriced over the last couple of weeks.
Yeah, you mentioned that we're going to potentially get a new Fed chair this month, or at least know who it is. I actually heard somebody speculate that we could get it before the Fed meeting on the 10th. So that will be very interesting to watch. If it's Hassett, market's not going to be surprised. He's been the favorite. Who knows? I guess that's as good a guess as any, but the market is clearly going to be paying attention to that in terms of how much dovishness we get. Maybe how much of a loyalist to President Trump we get, maybe is another angle there. So let's go to your charts here, Adam. I thought it was interesting the some of the days in the past couple of weeks where we've seen good breadth. You alluded to it, right? I've been watching the Equal Weight S&P 500. It's done a little bit better here, and I guess that better breadth has been reflected in the percentage of 4-week highs versus the percentage of 4-week lows. That's not shown here, but that has ticked up nicely here as well, I've noticed.
Right. And when you usually get that inflection point, when you start to get new 4-week highs outpace new 4-week lows, at least from this recovery standpoint, that's usually a good indication. Maybe the selling pressure is over. Certainly a big comeback for bulls last week. Interesting spot as well, right around the October lows, 65.50. You can see the 100-day moving average there as well. That's where they stepped up right at support, pushed the index back into its prior rising price channel. So I think a good sign for the market going into year end here. Still some resistance to clear. If you look, it's kind of hard to see, but 68.51, 68.70, that's the November highs. That's really the next level to clear. I think that would maybe wave the all clear sign of this pullback being over. And on the momentum front, the directional movement index in the middle panel triggered a buy signal. So when the green line crosses above the red line, just to keep it simple, that's a buy signal. Not a strong one. That ADX line in black measures trend strength. You usually want to see that above at least 20. But nonetheless, we did get an inflection in momentum. And then we also had that increase in breadth, and that triggered a potential Zwag breadth thrust, which is shown on the bottom panel. We're looking at a 10-day exponential moving average of advancing shares. So when it gets, we'll call it oversold or washed out, it crosses below 0.4 and then crosses above 0.615 in 10 days, 10 trading days. That's when you get these breadth thrusts, which have historically been a positive signal for momentum to continue in the market. We're watching that. The 10-day period ends on Friday. So a key indicator to watch this week for stocks.
And Adam, is the TMI based on moving average momentum?
Essentially, it's looking at advancing shares and declining shares and positioning around that. So it's not just a moving average of momentum, but it's essentially looking at trend direction and then trend strength.
Trend direction. Okay, great. Not only does our audience probably need a little bit more color on that, but I do as well. So thank you for that. Speaking of breadth thrusts, here is, I guess, how that shapes up against prior episodes.
Yeah, so going back over the last, I think, almost 20 years here, here's the previous breadth thrust signals that we've had. Average performance 12 months later for the S&P, and that dashed line is 22%, all of them positive as well. We only have data going back to 2008 just for reference. We're tracking above average. You can see currently we're at the 7-month mark from the April signal that fired on April 24th coming out of the Liberation Day lows. So maybe there's some room here for, call it a consolidation, and considering we are quite a bit above average for this stretch at the 7-month mark, but nonetheless, a good sign, I think, overall, if we get another breadth thrust signal by the end of this week.
Yeah, a lot of these periods were challenging, certainly. We had a big sell-off in 2015. We had kind of, I guess, 2013 sort of fiscal cliff, coming out of the European debt crisis. Same with 2011. And then we know 2009 was obviously a rough time. So I guess it's coming out of these big, sharp downdrafts, and then you get a major move higher. That, generally speaking, is a good time to buy. I mean, we know that in hindsight, but that's how I think about this. Is that all fair?
Right. And I think the simple message, breadth moving in the right direction, it was getting to a pretty concerning point just over the last couple of weeks when you look at how many stocks are above their 200-day moving average, when you look at some of the new lows. We finally had a capitulation in market breadth, and I think that's really what we're showing here in a relatively extreme way, just from how oversold or washed out breadth was to the inflection point now back the other way with breadth expanding.
Makes sense. So a lot of people talk about the VIX. I guess it's behaved lately after that little bit of a spike.
Right. So when you think about trying to identify a inflection point in equities, when is this pullback going to be over? Of course, we look at price action. Are we recapturing key support levels for the S&P? I think we can check the box there. You look at momentum. We highlighted that DMI indicator crossover. We look at breadth, as we just indicated, with an improving backdrop. And we also look at sentiment. One way to measure that is with the CBOE volatility index, or the VIX. Some people call it the fear gauge. And excuse me, when you look at price action just over the last couple of weeks, we had a spike to near 30. Now, that doesn't reach or cross the threshold of the back test that we've done. Anything above 30 is typically where you get your capitulation point. But we did get a lower high compared to October. We crossed back below the 200-day moving average. Consider that a move to risk on. And then the VIX futures curve shown in the bottom panel moved from backwardation, where the front month is more expensive than longer dated contracts. That's not normal. When you have fear running into the market, you typically see the VIX, the front month, trade at a premium. That's called backwardation. And now we switch back to contango, where the front month is cheaper than the longer dated contracts. When that crossover occurs, that's another good sign of a potential, or the potential that we did reach peak fear. So I do think that this is another signal here, maybe that this pullback period is over for the S&P 500.
So maybe the takeaway here is the odds favor a perhaps choppy but upward trending market between now and the end of the year.
I think that's fair, considering just where we're at with price action and where volatility stands right now.
Yeah, kind of putting all these pieces together, I get a little bit of a bullish sense from you, but because you think that the pullback might be over here, but certainly after such a strong run, there are a lot of reasons to think that maybe we could have another little bit of a dip before the end of the year.
Yeah, we haven't checked all the boxes, but we've certainly checked some important ones with just the recovery in price. As I mentioned, breadth, momentum, sentiment as well. But there are some missing pieces as well, and we'll get into those with just leadership. And I think just the lack of retail stepping up to buy the dip over the last couple of weeks. We look at a lot of the positioning data, and they really haven't shown up in a material way. And that's new to this recovery over the last 7 months. They've been consistent buyers of U.S. equities, and they've been continuing to de-risk, surprisingly, over the last couple of weeks here.
Yeah, retail's kept this market going all year, buying every dip, but maybe they finally are starting to run out of steam. So you mentioned leadership. Here's a really cool visual of it, right? So explain what we're looking at here, Adam. I mean, I know that you want to be upper right.
Upper right is the place to be, and that is indicative of the sector outperforming the S&P 500 and also demonstrating better momentum. So that top right quadrant, that's the leadership quadrant. Vice versa, the bottom left, that's the lagging quadrant. So underperforming and worse momentum. And we track these on a weekly basis. The most recent is the filled in, call it a diamond. I guess we'll call it a diamond or a square pattern. And that's how these sectors have rotated over the last month. And you can see healthcare is now in the leadership quadrant. You have utilities moving to that top right leadership quadrant, energy, real estate, consumer staples, all improving while areas like comm services, tech, consumer discretionary, financials, industrials, materials, you get the idea, are all more in the lagging or weakening quadrant. Now, this is a new composition of leadership we have not seen in 7 months. This is really the first real sign from a relative strength standpoint where we've actually witnessed real risk aversion taking place, where there has been a rotation. And when you think about these breadth metrics that we talk about, you have to think about the composition of breadth. A lot of what we've seen in breadth has been more on the defensive side. So areas like healthcare showing a lot of improving breadth. Even the utilities has the best breadth within the S&P 500. So you have to be a little bit careful at looking at just the headline number on breadth and think about what sectors are actually driving it. And right now for the market, it has been defensive. So for this rally to continue, I think you're going to want to see these more cyclical sectors, call it consumer discretionary, financials, industrials, start to show improving leadership qualities. Just haven't seen it yet.
Yeah, November, as I mentioned, not a good month for consumer discretionary or tech. October was decent. So this is not a long-term type of sustained period of underperformance. It's short term, but still it's something to watch and we might be seeing a shift. So really cool graphic here. Healthcare we've talked more about in our investment committee meetings. Not quite ready to jump in and overweight it, but certainly we're close. So that is a sector we'll continue to talk about as the year winds down. All right, so I guess this is a similar concept, Adam, in terms of internal trends. Is this a breadth look?
Right. So we break down the S&P 500 by trend, and we use a shorter term, an intermediate, and a longer term moving average. We have a proprietary model that we look at each moving average relative to each other to really define trend. And when you look at the S&P 500, the internals here, the more green on your screen is the higher percentage of stocks in uptrends. And flashback to the summer, call it July, August, you had almost 75% of the S&P in some form of an uptrend. Since then, we've had a deterioration in uptrends within the index at the expense of more downtrends. You can see in red, that's just indicative of more or a higher percentage of stocks in downtrends. And right now we're running at about 56% of the S&P 500 in some form of a downtrend versus I think we have 44% up there of stocks in some form of an uptrend. That's not a great combination when you think about the sustainability of a rally. So this is another data point that we're looking at to start to improve from here. If this is going to be a sustainable rally, especially into year end, you're going to want to see it broaden out and more stocks enter uptrends. Even when you look at the composition of trends, the stocks that are having the highest percentage by sector in terms of uptrends, you have utilities, healthcare, energy. We'll throw industrials in there, so that's a positive. On the downtrends right now, real estate, comm services, staples, discretionary, so a little bit more cyclical. Tech, you can see obviously a big component of the S&P 500. 56% of the tech sector now in some form of a downtrend. That's a little bit concerning considering it's about a third of the S&P 500.
Really interesting. Everybody's talking about concentration and narrow leadership. It's been a conversation point all year, actually, probably 2-3 years.
Yeah.
It feels to me like this is a very tough environment for us to rely on the Mag 7 for another leg higher because we've seen more dispersion in the Mag 7, right? Just what we've seen recently with Alphabet shares doing well and at the expense of NVIDIA, right? And you've seen a little bit of technical breakdown in Meta. I don't think the chart on Microsoft looks quite as good as it did a couple months ago. So I wouldn't look for that area to lift us to a big year-end rally, at least my personal opinion. It's going to take this improved breadth, more of the soldiers and less of the generals.
Right. I would agree there, especially just looking at the individual charts of the Mag 7. To your point, the dispersion there has grown and continued to grow over the last few months with Alphabet outperforming Nvidia down considerably last month. So I think 25% delta between Alphabet and Nvidia just last month. Only two of the Meg 7 components were higher in November. Everything else underperforming the S&P 500. So I would agree there that it's going to take some broadening. And again, you're going to want to see it in more cyclical areas. Financials would be a good one as a starting point to see some of the banks breaking out. It's not that they look terrible on the charts. They're just really in a consolidation phase, which when a market's recovering and making close to new highs, that leads to that relative underperformance that we're seeing in some of the charts here.
All right, it is December, so time to look at our monthly seasonals. What do you
Right.
see?
And I think I've already had quite a few questions on what's going to happen in December. Santa Claus is going to show up. When you look at the progression of the S&P 500 over the last 75 years, you can see here by the trading day of the month, it's typically a back half story. Most of the gains start around the 11th trading day of the month. So it's typical to see some consolidation, maybe some even downside in the market until we get to the midpoint. And then you have that Santa Claus rally period, which is characterized by the last 5 trading days of the year plus the first 2 of the new year, usually a very strong period for a 7-day window. And then just December overall has been a pretty solid month, up over 1%, has the highest positivity rate as well for any month. So definitely a strong seasonal period. You just might have to wait a few days, or I guess in this case, a couple weeks for that seasonal strength to show up.
Yeah, get past the Fed meeting and
Yeah, lines
catch
up
up,
well with the Fed meeting, of course.
and then catch up a little bit on this data because we're still getting stale data. A little bit of uncertainty for the next several weeks until they get caught up. Actually, it might even take into January, but there's more catch up to go. So good stuff, Adam. Let's shift gears to the weekly commentary. Now, you wrote a lot of these sections here that I'm going to highlight. So kind of under the radar keys. So first, dollar. This this chart looks pretty good to me. It's held this uptrend. Maybe we don't want the dollar to go up, but it looks like it's gonna go up. What do you think?
I think you have to respect the secular uptrend here that's been in place going back to the 08, 09 lows. And we're kind of consolidating right above it. We've retested it a few times. You look at the prior retests, it takes a while to form a bottom here. Maybe that's what's playing out in the dollar index. And speaking of keys, I think this is really going to be key to not only the commodity space, but also international markets, which have had a pretty impressive year, as you highlighted earlier, in terms of outperformance. The dollar rolls over here and breaks below, call it 96 on a sustainable basis. That's really, I think, the signal to shift maybe to international, especially emerging markets. They're the most negatively correlated to the dollar. And then you also have to ask, what does that mean for commodities right now that are starting to break out to new highs without the support of oil at an index level? And then extrapolate that one further. What does that mean for inflation? If commodities are rallying to multi-month or multi-year highs in metals and some of the ag space, and if oil starts to work, it could complicate the inflation story for the Fed. Of course, with the dollar right now, I think, like I said before, respect the uptrend until you see it break down. But if it breaks, there's some pretty big implications for 2026 here.
Yeah, absolutely. If we break that uptrend, you want to go into international a little bit more, especially EM, as you mentioned. So that's one. We only have 3 charts from the weekly commentary, but there are, I think, 7 topics. So here's the next one: corporate deal making on the rise. This is relevant for alternative investments, particularly merger arb strategies and private equity, right? Because if you have deals, then you're giving private equity ways to exit. The IPO market does the same thing. So you can see here from this chart, after this bump up in 2021, 2022, when we had, of course, very low interest rates, came back down in 2023 in terms of number of deals. They have started to pick back up again. So 2024 had more than 2023, 2025 had more than 2024, and we think this keeps going higher. So this is a reason to maybe be a little more interested in alternative investments. By the way, a little more volatility potentially next year. Plus, I mean, not necessarily an 18.9% drawdown, which I'll show you on the next chart. Not necessarily that kind of a drawdown, but we're not going to have essentially 7 months straight up, we don't think, and a 17% year, right? So if you have a smaller gain in stocks next year and you have a little bit more volatility, or at least more consistent volatility, then that's going to be a better environment for alternatives. Some of the other topics that we hit here, the midterms. So Adam, you wrote about that. Midterm years are more volatile. You have uncertainty heading into the November elections. So that's something we'll have to watch. And then of course, geopolitics. That's been a key driver of markets almost as long as markets have existed. But given the trade situation, we'll have to continue to watch geopolitics. And then the commodity markets, Adam, you also wrote about the commodity markets. We'll have to watch how geopolitics and trade policy influence gold, copper, oil, right? We might get a peace dividend out of Russia, Ukraine. Anything else you'd highlight? I covered a lot of them, but anything else you want to highlight from the content that you created in the Outlook?
No, I think you covered it pretty well, just how much influence geopolitics has had. Of course, it always has an impact, but I think just over the last year, it's been especially apparent with the trade policy, what that means not only for commodity prices, how that's impacted the dollar. There's been some de-dollarization trends that have developed. I think if the trade war continues and we continue to have volatility around trade and call it a dynamic backdrop on trade policy, it alludes to higher volatility and probably some big moves in the commodity market, if not the dollar as well.
Yeah, so we'll probably have another year of a correction and average S&P 500 returns or better. That's, call it around 10%. And then, I mean, hopefully correction's smaller than 18.9, which was what we did in April and May. But we'll still probably get a correction. But this chart, which compares the full year returns to the max drawdown within each year, one of my favorite charts, is a really good study to keep in mind when we do get volatility, because it tells you that it's pretty much always the best move to ride it out, especially if you don't get a recession. So those are some of the under the radar things to think about for next year. The the on the radar things, right, which are like the Fed and AI, the stimulus bill, the OBBBA, right? Those were all covered in the weekly market commentary 2 weeks ago. I think the date on that was November 17th. So just sort of filling in the rest. Look for the Outlook to be published and on LPL.com next week on the 9th. All right, so the preview, this could be our fastest week ahead preview, Adam, because I think all people need to do is shop, because I don't think this stale data is particularly meaningful. What would you be watching? Would you counter that in any way?
The ADP employment report Wednesday, that's going to be the big one, I think, in terms of for the Fed. Obviously, they're not going to have any new labor market data on the non-farms side. So that probably takes on more meaning than usual. Of course, they like the BLS data, but they don't have it. So the ADP probably is going to be a big one. Pretty low bar at 20,000 in terms of survey. The prior month, 42,000 there. It has been interesting, though, the last 3 weeks, when you look at the 4-week moving average of net payroll gains, it's been negative. So kind of some weak momentum coming into that print on Wednesday. It alludes to a low bar. I think anything positive, the market would probably view that as a good sign, but you don't want it too positive. That's the world we live in now, because that would maybe mean the Fed is less likely to come out with a big dovish outlook, I think, as the market's hoping for.
Yeah, we want Goldilocks, but there's probably a little more downside risk than upside risk. I would argue. So great point. That report will be important because it's timely, and we're still in this environment where we're relying on private data. The ISM was a little soft, 48.2 versus expectations of 49 this morning, but that's ISM manufacturing. That's been below 50 for most of the last few years. I don't think that's particularly meaningful. The prices paid ticked up just a bit, and ISM new orders did drop a couple of points. So those are negative, but we would argue they're pretty small negatives. So we'll just have to stay patient and wait for the data to catch up and see the like the October PCE will be interesting, and obviously the November PCE in terms of gauging inflation, and then retail sales, they're still behind. Of course, holiday shopping matters. By the way, the online shopping numbers for Black Friday were quite good, up 9%, over 9% actually. That's a nominal number, so if you adjust for inflation, it was still up around 7. And then the overall National Retail Federation forecast, I think, is still 4% year over year, which is not bad. It is nominal, but I think we're going to do a little better than that, but not bad at all. So even though you have this K-shaped economy of the upper end holding up really well and driving enough spending to offset some of the weakness that we're seeing at the lower income levels. So we think it'll be a pretty good holiday shopping season. That's why I wanted to do my part, Adam. So I wrote on this slide, shop till you drop. So everybody get out and shop. Some of you might even be done, but if you're not done, most of you aren't done, go out and shop and help this economy. So, and there are some tech earnings this week, but nothing, no huge names. A couple of retail stragglers, not really anything that interesting. So just watch the ADP jobs report, as Adam alluded to, and watch the shopping totals as they come in. In fact, it's Cyber Monday as we're recording this, so get out and go shop online. How about that? Got a lot of great deals out there. With that, we'll wrap. Thanks, Adam, for joining. Thank you to all of you for listening to another LPL Market Signals. We greatly appreciate your support. We'll be back next week. Actually, it's going to be a special Market Signals because we're going to go through the Outlook. We will actually have released it by the time next week's Market Signals is out. So stay tuned for that. And actually, next Monday, so that is going to be the 8th, LPL is ringing the bell at the NASDAQ, the opening bell.
Awesome. You'll be there, right?
I'll actually be there. So look for that. If you watch the Open on, whatever, CNBC or any of the other networks that show the Open, you'll see a lot of us. I think there's like 90 of us going. So that'll be fun. Hopefully we'll get our name up in lights in Times Square at that NASDAQ market site. So that'll be fun. So again, that's December 8th at the NASDAQ Open, because it's the 15th anniversary of our IPO, December 8th, 2010, I guess it was. So that'll be fun. So looking forward to that. So thanks again, Adam. Thanks again to all of you. Have a great week, and we'll talk to you next time. Take care.